Volatile trading on Wall Street Wednesday, the Dow swinging in a 650-point range. Let's get an assessment from Ryan Payne. He's president of Payne Capital Management. Hey, Ryan, a crazy day the past 3 days, and it looked like a repeat of yesterday after a morning rally fading in, and now we're back near to the break-even point at the S&P. What do you make of the quality of trading that you're seeing today?
I think we were grossly overdue for a correction. I mean, last year we had two 6% corrections, which was still kind of mild. Most years you get at least a 10% correction. And if you think about it, since December of 2018, S&P's up like 44%. So you got to get some profit taking somewhere. And I think this coronavirus probably spurred on a little more profit taking, and then fear kind of begets fear. And I think we're in the midst of that right now, Fred.
You say fear begets fear. Are you sensing any fear when you get calls from clients? What's the nature of it so far?
I don't think we're quite there yet. I'm still hearing, maybe more anecdotally, people saying like, hey, I wouldn't mind getting in here and taking advantage of the dip. And that's not usually indicative of a bottom. You need people saying, oh, I just can't put my money in the market here. That's usually a better sign. Now, that's more anecdotal. There's a little less science to that, more art. So I think just based on that complacency, you could see some more selling here.
Okay, so there's still some complacency in the market the way you see it.
That's right.
You mentioned correction earlier. Are you looking for a garden variety 10% correction, or could this be deeper?
I think it's probably more realistic. If you look at SARS back in 2003, I think it was something like a 14% correction. I don't think it would be crazy to think we get a 10% plus correction. Again, that's a very normal market move to have in any given year. In fact, the average year, you get a 10% correction.
The 10-year. We've talked about this before on the show, and I know you love this topic. People keep piling into the 10-year, and now they're piling in for a different reason. They're really scared, but does that scare you with 1.31 for the 10-year?
I'm scared for retail investors putting their money in bond funds in droves. It's almost like that commercial, what's in your wallet? It's like, what's in your bond fund? If you know the underlying investments in these things, you're getting to a point where a lot of stuff isn't tradable. We're talking about very low yields now, and if interest rates just go up a smidge, that stuff gets hammered because rates go up, bond prices go down. Then you've got a lot of retail investors that have packed their money in here that are all going to be running for the hills at the same time. It's like yelling fire in a crowded theater. It's not pretty, Fred.
So what should investors be doing at this point?
Well, equities are the best deal in town. And if you look at cash flow specifically, we talked about the 10-year treasury being at like 1.3%, which isn't keeping up with inflation, especially after taxation. I mean, you're talking about like no return. Dividends right now are rich. If you look at global dividends right now, you're getting over 4%. Dividends are going up this year. That are the projections. So equities are definitely the best buy here if you're looking on a relative basis. But you need to own bonds. Own them outright as protection in your portfolio, but stocks over bonds for sure.
Anything to pick up these levels?
I mean, again, I just talked about the international markets. I think they look really attractive here. If you're really bold, and I think as a long-term investor you should be, energy stocks have just gotten hammered here, but cash flows there are very, very attractive. And the reality of it is global demand for energy is going up over time, not down. It's once we get past this whole issue with the coronavirus, you're going to see demand pick up again in China. That's like a third of the world's growth in demand. I think oil prices here, oil stocks specifically, are probably a good buy here, even if you have to take a little pain, no pun intended, being my last name in the short term.
I thought you were putting your brand name there.
Clever.
All right. Thanks a lot, Ryan.
Thanks, Fred.
Our thanks to Ryan Payne of Payne Capital Management. I'm Fred Katayama. This is Reuters.